And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
You know, it always happens. It's Thursday, of course, second best day of the week. Michael Leibowitz joining me today, and what I mean by it always happens, I had everything planned out. I have to travel tomorrow on business. I'll be gone for the weekend, and so I had everything mapped out. I had my articles written, ready to go, all that. And then the Fed comes out yesterday, does something completely unexpected. Now I'm going to scramble to get everything changed. So. I said last week there would not be a newsletter this weekend because I was traveling. There will be a short update this weekend. So if you are subscribed to the newsletter, there will be a short update. I would be remiss not to provide a short update in this weekend's newsletter based on what happened yesterday. So again, a lot of things have happened. Like I said, Michael and I have a lot to go through from the FOMC meeting yesterday. We'll talk about the consequences of that meeting, what that suggests. We're going to have a little bit longer before the bell this morning as well, because there's a couple of things I want to go through that we've been talking about. And the reason is that I was wrong. Yesterday I said that, I thought the Fed would come out and be a little bit hawkish just from a prudent standpoint, given that rising asset prices, falling bond yields, which have been remarkable. We've had a marked decrease or easing of financial conditions, which is by their nature inflationary because people feel better, they go out and they spend money, and that causes prices to rise. But and again, I thought just from a prudent standpoint that the FOMC should come out and be a little bit cautious, right? Just, not throw all caution to the wind, but that's exactly what they did yesterday. Not only did they basically put in the tank that they're done hiking rates and they're ready to start cutting rates, and it's something that they're analyzing, but the dot plot also, and we'll talk about this morning with Mike, but the dot plot also shows 75 basis points of rate cuts next year. And that's out, look, there's no recession on the horizon. There is nothing right now that suggests you're going to have a recession or deep disinflationary pressures, which is why the Fed would be cutting rates. So, again, it was a very shocking meeting yesterday, extremely bullish for the markets. And so let's kind of go through this. So again, so bear with me. It's going to be a little bit longer before the bell video this morning. But again, I think there's some important points to go through. So here's what you need to know before the bell. Yesterday's FOMC meeting took the bearish bias off the markets. And again, look, markets are very overbought. We've been talking about this for a while. Markets are extremely overbought here. Everything is kind of pegged in terms of their bullishness, right? So retail investor sentiment is extremely bullish now. 90% of stocks are above their 50-day moving average. Whenever historically you get this overbought, you get a correction, but it doesn't mean it has to happen right away. And that's basically been the case here. And again, we talk about this whole Santa Claus rally issue, what's going on. That is, despite the fact that we didn't get a correction, something we'd said earlier in the month that we could get a correction or consolidation, that's exactly what happened. We consolidated this market for about 3 weeks coming into December as mutual funds are making their distributions. The Santa Claus rally has now arrived about a week early, but we are off to the races here. And, markets, again, very overbought. No doubt about that. Flipped the buy signal back on yesterday from a very high level. So that's, that doesn't give you a lot of room to work here because you are very extended on the signal. And markets are really overbought on a relative strength basis. So, that hasn't changed. It's just kind of gotten worse over the last day or so. But there are some important kind of technical things that are going on that are certainly much more encouraging for the markets going into 2024. So we need to take a little bit longer look here at the markets and look at what's going on here. So first of all, we are now very close to marking all-time highs. We are within 2%. Basically about 1.5% really of all-time highs on the market. So it is very likely by the end of this week, not this week, but the end of next week, the markets will set all-time highs. And so we're going to basically wipe out all of that decline that we had in 2022 will have been marked out in 2023, and we'll have completely recovered that. Also from a technical basis, there's what's known as a cup and handle pattern. And this is a very bullish formation for stocks. And generally, when these patterns complete, and we're very close to completing this pattern, you are going to have higher asset prices in the future. So basically, it would augur for a much stronger market next year than many people are expecting. But you had this very nice cup handle, kind of the cup formation building. So we had this previous market top. We created this cup in the markets, which is this decline that was in 2022, this rally that started in October. You then had this correction in July, in August, September, October of this year that then created this handle pattern that we are now in the process of completing the breakout of that handle pattern. So this all suggests that markets are very much back into a bullish mode for now. And again, look, things can change, and this is why it's important to always manage risk, manage your outlooks, those type of things. Right now, this is a very bullish pattern. Now, that does not preclude the fact that we can have another 3 to 5% correction at all. But again, going back and looking at markets from being this overbought, this extended, this deviated from moving averages, etc., you are going to have a 3 to 5% correction at some point. Now, when that occurs, it could happen tomorrow, could happen Monday, could happen next week. I don't know when it'll occur. It will occur. But that is going to be a buying opportunity, not a selling opportunity. And so when markets get back to working off some of these overbought conditions, and they will. And again, all you have to do is look at the markets over time, right? So people get this idea that markets are just going to go higher from here. Nothing's going to stop this train. It's all up from here. Markets don't work that way. I mean, all you have to do is look at a chart and see that prices move up and down over time. So, it's important not to fall into that trap of being, pushed into making investments, buying things that are really overbought. You'll have an opportunity, be patient, and you'll get a better point to add exposure to your portfolio. Very quickly, let me switch over to bonds because that's the other big topic right now, something that Mike and I will also get into today as well. Yesterday, so this is a chart of the Treasury yields, right? So this is interest rates, not the prices of bonds, which is why it's going down, not up. Bond prices going up, Treasury yields going down. One thing that we've been talking about for a while is that as we start getting through this process, yields are going to fall as inflation comes down, economic growth is slowing. We are seeing slower rates of economic growth. That's going to pull these yields down. Mike and I have been writing that yields were improperly priced for where we were economically. The yields were way too high relative to economic growth, and that was going to revert. We are now going through that. We are going to take out the 200-day moving average today on 10-year Treasury yields. That, just like the market, is going to augur for lower bond prices. Higher bond prices, lower yields. Now, again, there's been a very big move here. We're probably going to see some point here where yields back up a little bit. But just like the stock market, when yields correct or stocks correct, and they'll likely happen together for whatever news drives that, that's going to be your opportunity to add bond exposures to your portfolio, etc. But again, yields very overbought here, just like stocks are very overbought. So you're going to get a little bit of a correction here at some point, give you a better opportunity to shift duration in your portfolio, something that we'll do as well. But yields are now very back into a bullish trend. So if you didn't lock in those 5% yields when we were talking about it, that opportunity, probably gone. So again, we'll talk about that some more. That's what you need to know before the bell this morning. When we come back from the break, we'll pick up with Michael Leibowitz. We'll get all into it. We got a lot of stuff to talk about this morning, so hang around. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com. Click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And well, ready? Okay, sorry, didn't sound like my mic was on. Good morning, welcome back to the show. Of course, Michael Leibowitz joining this morning. Real quick, Mike, before we get into this, I have to air a bit of a grievance, and it was just because there's an article in the on CNBC this morning talking about a self-made millionaire who used to work at McDonald's shares 3 tips on things he refuses to tip on, and the tipping thing is getting out of control. They are now tip shaming you at. I'm dead serious, right? They are tip shaming you at checkouts. I went to a restaurant with my wife the other day, and you have to walk up the counter. You got to order your food. You got to pick up your food. You got to bus it to your table, clean your table, put everything away. And so when you go to check out, they flip the little screen around, and it used to just say the tip. And we go to this restaurant all the time. It's a very, very good little restaurant. We enjoy it. And so they just flip the screen around, and it would just have 10%, 15%, 20%, 25%. Or no tip right there at the very bottom. There's a little line at the bottom that says no tip, just move on. Now it says, when they flip it around, it says 10% tip, good. 15% better. 20%, awesome. 25%, you're fantastic, right? And so now they're tip shaming you. And I'm doing all the damn work other than the cooking, right? Which I'm paying you a profit for. This is like self-checkout at the grocery store. It's like, I want some cheerleader to come out and go, woo, you did a good job. I should be tipped. Anyway, I just had to say that because I noticed this last night because, again, it was a change to the screen. And I went, no tip, and it went, boo, gave me a sad face. Exactly. Gives you the raspberry if you push the no tip. Anyway, speaking of tips, Jerome Powell gave one to the market yesterday. Not surprised. I guess, and again, like I said, I was wrong. I expected the Federal Reserve to be a little bit more prudent, I guess. Just in terms of managing policy and managing expectations. And again, just as we wrote about last Friday, that there's a psychological training to the markets that's been going on. And it was interesting. George Gammon, who has a YouTube channel, picked on my article that was our article got posted over on Z or Hedge, and he picked on it. And basically our comment is that over the last 13 years, because of the Fed increasing their balance sheet, keeping interest rates at zero, they basically trained investors that whenever they're doing QE and keeping rates at zero, you buy stocks. You don't want to be in cash. And that was the whole point of the Fed program, which was to get yields on cash as low as possible to give you no alternative other than to move money into other assets, be it real estate or stocks or bonds or whatever, to get a higher yield on your cash. And, there's a very clear, and what we show in that article is a very clear correlation between the Fed's balance sheet increases, and not just the Fed, but central banks globally, whether it's the ECB or the Bank of Japan, whoever doing QE. Very clear correlation between those increases in central bank balance sheets and financial markets. Now, that doesn't mean there's a direct connection. In other words, the Fed's buying stocks. Bank of Japan does. But, the Fed did buy bond ETFs back in March of 2020 to bail out the bond market. So, but there is the transmission system from the Fed's balance sheet into the markets, and Mike and I had a long debate on this yesterday on the phone, is not clear, but there is a psychological link between the markets and what the Fed does. And this is now obvious. And again, we've now trained investors to do this. And, investors have been front running the market now for the last, really since the end of October, on expectations of a pivot in Fed policy. They were right, because yesterday at the FOMC meeting, the Fed pivoted very clearly in both the comments they made as well as in their dot plots. And Mike, do you disagree with that statement?
No. And, I think if we go back to when this rally started, that was sort of the market, when the market thought there was a pivot. That was when they said the long end, with higher interest rates in the long end, 10, 30 years, that the market had done its job for them. And that's when the idea of a pause started. And ever since then, the Fed has, been, let's call it relatively dovish. It's not dovish necessarily, but it's certainly becoming more dovish. Mm-hmm. And, like you, I was a little surprised yesterday. If you put yourself in their shoes, what's the upside to becoming more dovish? Keep fighting the inflation, fight the economy's doing well, but they took a more dovish tilt. Yeah. So, Lance, in my mind, it's either one of two things. They know something that we don't know, and we've talked about that mm-hmm. before. Maybe the banks are in a lot more trouble than we think, or they got a tap on their shoulder a couple months ago from the Treasury or from the banks mm-hmm. saying, you better get rates down because we're struggling here. So something changed in the Fed's mindset, and whether it's based on their guts that they just think the economy is going to slow down, that they've beat off inflation and it's over, or someone's telling them what to do. I guess that's what we'll find out.
Yeah. Well, look, there's clear evidence that, that monetary infusion that we did in the economy back in 2020 and 2021, that, checks to households and extended benefits and all that other stuff, that pig in the python is now exiting the system, right? M2 as a percentage of GDP is declining. So that support is going away, and as you and I have talked about, there's certainly going to be pressure on things like housing prices and others. And, so we've seen that, right? Housing prices have come down, although not a lot, but they have come down. Affordability is still an issue for many. And, there certainly doesn't seem, though, at the same time that there's any big risk of recession, despite the fact that, we have inverted yield curves. And, the yield curve began to uninvert sharply yesterday with the really sharp drop in the 10-year Treasury. And today, Treasury yields are looked to open below 4%. So we're going to be like at 3.95% on the 10-year Treasury this morning. That's going to bring mortgage rates down. All this seems to be kind of working. And again, this is all financial conditions. This is, what we talked about, ad nauseum for a while, this is all financial conditions. And those are easing rather rapidly on consumers. Lower mortgage rates, that's going to help, maybe stabilize the housing market. The National Association of Realtors and others have been complaining about, the unaffordability of housing prices. Well, you get yields down, that's going to help the affordability to buy a home. That'll help the housing market. That'll help the real estate market. Lower yields obviously helps the bond market and the stock market. So this is certainly going to give people a lot more incentive to go out and spend money. And again, that kind of runs the risk of a resurgence of inflation, but doesn't really seem to be an issue the Fed's too concerned about right now.
Right. And financial conditions is the key word you use there, because that's the word they used in October that or September, whenever that was, that financial conditions have tightened significantly, that we may not have to raise rates. Mm-hmm. Well, we've gone a couple months. Inflation continues to come down steadily, but it's not near their target yet. It's still 3% and higher. The job market, maybe labor market's slowing a little, but it's not, I wouldn't say it's collapsing or even recessionary. It's just not at the fast pace it was. But financial conditions have eased very significantly, right? Mm-hmm. Interest rates, the stock market, the dollar's weakened. Those were the three things the Fed pointed to. And they've reversed everything that's happened since then, but the Fed doesn't seem to care. So again, it's a little mysterious as to what they're doing here, or what they see or what they're being told to see.
Right. Well, and something I want to talk about when we come back after the break here is just to kind of set everybody up is, look, there's still a lot of very bearish commentary out there right now. The yield curves are inverted. No doubt about that. We've had a very, very long period of yield curve inversions. You take a look at, a variety of other economic indicators. There's leading economic indicators and others, certainly suggesting, recessionary pressures in the economy. Yet at this point, it doesn't seem as if a recession is really all that imminent. And again, there's been this very divided camp in the markets over the last year between those expecting, a deep recession because of these indicators. And, there's been another camp that's like, hey, we're probably going to have a soft landing and all this. And, that's never been achieved previously where you've had an inverted yield curve and no recession. So this is going to be very interesting. Has the Fed, because of all this liquidity that was in the markets previously, still working its way through the system, then the Fed starting to cut rates, what seems to be early to the game, right? They seem to be setting up the markets for early rate cuts, rather than waiting for something to actually break and they start cutting rates. It seems like they're going to try to cut rates early, that they might actually pull this one off. I mean, I think that's going to be the big question is, can they actually navigate this soft landing? Or to your point, Mike, is there something else brewing in the economy that, or the financial markets, et cetera, that we're just unaware of at this point? We've certainly seen some interesting things with repo here recently, but is that really the kind of the crisis indicator that a lot of the kind of the mainstream media is trying to make it out to be? That's going to be the big question,
right?
And so and that's a good point to actually kind of start with here, Mike. So we'll come back. We'll talk a little bit after the break about repo, what's going on with that. The inversion of the yield curve, leading economic. Are they all wrong this time? I mean, you've got to answer that question, because the answer to that question is going to drive all of your investment outcomes for next year. And if you get it wrong, you're going to get it wrong in a big way. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
People watch these shows like, I can't believe these people. It's like, it's called scripted reality for a reason.
It's just like WWE with music.
Exactly. I asked my wife when she watches that stuff. She's like, but it's so good. I'm like, you know it's not real. Yeah, but it's so good.
Good for what?
The Real Investment Show podcast. Same show, your schedule.
She calls it mindless television. It gets her brain. It gets her brain off of work.
Lose brain cells watching that stuff.
Well, you explain that to her, and I will put y'all two in a room and let you deal with that. I promise you won't come out on the better end of that one.
I'm afraid of her too.
Y'all haven't met my wife, but my whole office is terrified of my wife.
The Real Investment Show podcast. Same show, your schedule.
So just
She's upstairs, isn't she?
She is upstairs.
Yep.
She's upstairs right now, as a matter of fact.
At realinvestmentadvice.com.
Probably listening to the show. So,
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So, as we're talking about, the Fed yesterday, much more dovish than expected. That has in turn fueled a rather vicious short covering rally yesterday. Stocks across the board were up. S&P was up about 1.3%. Small caps were up almost 3% yesterday. So just everything that was underperforming, lagging, whatever, just had shorts bet against it. Just had a huge short covering rally yesterday. And we're in a stone throw now of all-time highs, and the markets are going to gravitate towards that all-time high mark. They may just clip an all-time high and then have a correction. But, and again, when we talk about correction, that doesn't mean a bear market. It just means 2, 3, 4, 5%, and then you go on your way. But there's this natural kind of magnetic point now in the market, which is the markets just want to get to all-time highs. It's just a pull, like gravity to get there. So we're probably going to make all-time highs by the end of this week, next week, at the latest. So the point is, though, is that this is certainly undermining a lot of the more bearish commentary that's been out there. And again, there's when we talk about bullish and bearish commentary, it's not poking fun at anybody. It's not saying one side's wrong, one side's right, because both Mike and I are constantly analyzing the bearish arguments as well as the bullish arguments and trying to navigate the markets. That's all that means, right? But we've gotten into like society in general, we've now gotten into this very divisive point in the markets where, if you're bullish or you're bearish, you're in your camp and you can't get out of it, right? You've been labeled that and you're stuck there. But that's not the way to manage money. You've got to analyze both arguments to try to figure out where things are going. So look, the bearish arguments have a lot of historical evidence tied to them. And there is a reason that it is worth paying attention to some of the bearish arguments. And again, we're going to talk about yield curves. We're going to talk about, leading economic indicators, et cetera. But Mike, before we get to that, one of the latest kind of alarms for the market has been this massive decline in repo that's been going on. And I've been getting a lot of headlines, a lot of questions, a lot of, videos being sent to me off YouTube channels that are saying, hey, the next big crisis is coming because of this drain of the repo system. Is that the case, Mike, or is there something else going on?
So the Fed has what they call the reverse repo program, and what the Fed does is they don't dictate the Fed funds rate. They manage the Fed funds rate. So when they say it's 5.25%, that doesn't mean anything.
Mike, let me just stop you real fast, because that's a super important point. If you can go to the FRED, so you can Google FRED, which is the Federal Reserve database of economic data, and you can download the historical data of the Fed funds rate. And what you will notice is it's labeled the effective Fed funds rate. Right. To your point, Mike. So sorry, I didn't mean to interrupt, but that's an important point about they manage the rate. They don't set the rate.
And let's even take one more further step back. What is Fed funds? Fed funds is the rate that banks lend money to other banks or borrow from other banks overnight. So it's the overnight borrowing rate. And that rate kind of helps spur the economy or slow down the economy. So the Fed manages to a rate, and in order to assure that the effective rate, which is the daily trading rate, is very close to their target rate, and most days they're not identical. It'll be a little above, a little below. Quarter ends and year ends, you can have some wild swings in Fed funds. But what they do to manage it is inject money into the system or take money out of the system and basically fool around with the supply and demand to get it to be about, where their target is. And they've been very successful at that for decades. They've always been doing it. They have different ways of doing it. During the pandemic, there was a massive amount of liquidity hitting the system. So the Fed didn't introduce, but what came back was what's called a reverse repurchase program. And that was where the Fed would borrow money from banks and money market funds for overnight periods. And what that does is it pulls that excess liquidity out of the system. So the reverse repurchase program went up to like 2.4 trillion. And now it's come down. It stands a little bit over $1 trillion now. I think it's 1.1 or 1.2 trillion. So what that's kind of telling us is that there was a massive amount of excess liquidity in the system that if they would have done nothing, Fed funds would have traded well below target, which meant that Treasury bills would have been way below where they should have been, and it would have dragged other interest rates lower, which would have made the Fed's job of fighting inflation harder to do. So because the Fed got involved, not involved, but they have this facility open and they allow money market funds and non-banks to participate as well. They were able to drain the excess liquidity and allow Treasury bills and Fed funds to trade where where the Fed wanted them to trade. But again, now we're seeing that program fall off. And part of it is because Treasury bill rates are slightly higher than the reverse repurchase repo rate. And it's telling you that excess liquidity is leaving the system. That excess liquidity is going into Treasury bills, and that's good. It means there's this bank of money that's ready to fund the government. So again, all this extra money that the government needs that they're borrowing is not really as the money's there. It's not as hard on the investment world as we're being told it is. to raise the money.
Right. And that's a key point, Mike, because, that's been one of the arguments is like, oh, the government's issuing all this debt and there's no buyers for it. And, that was the argument back in October as the yields were approaching 5%. On the 10-year Treasury, we were like going, hey, that's not the case. We wrote a couple of articles, both you and I wrote articles talking about that, this isn't, the issue that everybody makes it out to be, and that there's plenty of buyers for the bonds that will always come up and buy those bonds because of exchange rates, et cetera. And since then, of course, yields have fallen sharply. And to your point, there's a huge amount of cash sitting there ready to buy T-bills, and this is what's going on.
And the Treasury has also shifted their focus more towards Treasury bills and away from notes and bonds. Mm-hmm. So they're putting more pressure on the Treasury bill market, but there's this supply of money there that is funding them. But what's going to start happening is that repo program goes to zero. It's telling you the excess liquidity is out of the system. And that's where we have to pay a lot more attention, because now when the Treasury needs money, they have to drain liquidity from other sources. It's not coming from reverse repurchase anymore. It can be coming from the money markets, which kind of like QE, it will start having a similar effect.
Right.
The opposite effect, but a similar effect.
Right. And again, this is one of the big issues that, there's a lot of money that's hiding out in money market accounts now at 5%. I mean, I can't tell you how many people I talk to. It's like, I'm not even in the markets right now. I just have all my money in 5% CDs or a 5% money market account. Well, right. in the next couple of months, they're going to wake up and realize that money market account's no longer 5% or CDs are no longer 5% anymore. And, markets are going to be up, 15, 20%. And, now I've got to make that shift back into the financial market. So or into longer duration, fixed income, whatever it is. But there's a lot of cash that's sitting there in these other financial assets that may move back into other assets that may provide a higher yield.
And this was the conversation we had with a lot of clients. Why are you buying 10-year, 5-year bonds at 4.5%, 4.75% when you can put it in the money market and earn 5.25%, or Treasury bills and earn 5.25% or even more? And this is the answer. Because that 5.25%, 5.5% is going away quickly. And what do you want to lock in? So again, liquidity is leaving the system. The Fed is still doing QT, which also pulls liquidity from the system. So look, I'm not pulling a fire alarm right now, but what I am saying is that over the coming months, if the repo program continues to fall at the rate it's been falling, that program will get pretty low, and we run the risk of liquidity problems. And this is what happened in 2019 that no one was really paying attention to, that there were hedge funds that were just having a lot of trouble borrowing despite having very good collateral to borrow. Mm-hmm. That's because there's not enough liquidity to go around. So, as we get into February, March, April, that's when this may become more of an issue, and we'll pay more attention. But it's something to put on your radar right now.
Yeah, absolutely. But now let's shift gears real quick, because it is something worth paying attention to. And again, as I said, there's, it seems at this moment that the Fed is, kind of, going all in. There's actually a very interesting article in the Wall Street Journal this morning called "The Federal Reserve is Underwriting the U.S. Recovery." In other words, what they're saying is that the economy has slowed down, and now the Fed is going to be cutting rates and providing, support to make sure the economy does not go into recession, that we get to that proverbial soft landing that the markets are hoping for right now. But again, if you take a look at a lot of indicators, yield curves, leading economic indicators, et cetera, still suggest recession risk is very elevated. We'll talk about that with Michael Leibowitz when we come back from the break. Don't go away.
Daily investment news you can use. Delivered at the speed of the internet at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Yeah, by the way, you've heard that ad this morning. Coming up on January 27th, Michael Leibowitz is coming into town in person. So if you'd like to come and hang out and visit with Mike in person, along with Greg Valliere and myself and Adam Taggart, we'll be having an economic summit talking about pre-election year market cycles, what's going on, what to expect. Kind of going through all the charts and graphics. We'll feed you breakfast and lunch, but tickets are on sale right now. There is a link in this YouTube description. So if you click on the description for this YouTube channel right now, the video you're watching, there's a link there for you to get your tickets. Like I said, tickets are going fast. There's only 150 seats available. The link is also live on our website at realinvestmentadvice.com. Right there at the top of the page, you'll see a banner. You can click that, and you can get your ticket secured. That's coming up January 27th. It's a Saturday morning. We'll kind of open the doors at 7:30, feed you breakfast. We'll run from about 8 to 12. Feed you lunch along the way as well. We'll have a panel, so lots of discussion, take live questions. It'll be a good time, be very educational. All right, so Mike, we just talked a little bit about reverse repo. That's been one of the big kind of bearish headlines out there. Another big kind of bearish headline, of course, is the continued inversion of the yield curves. Leading economic indicators have been in contraction territory for over 18 months now. A lot of economic data is still extremely weak. And again, historically, when you kind of line all these things up, you've always had a recession. The only time the Federal Reserve hiked rates and didn't have a recession was in 1995, but the yield curves weren't inverted. Never inverted the yield curve until 1998. Then, of course, you had your recession in 2000. And like I said, there's an interesting article in the Wall Street Journal this morning talking about is the Fed underwriting the recovery. In other words, are they acting sooner than what would normally be expected to try to keep the economy out of a recession? Do you think, let's just flip a coin here. Do you think they're going to be successful in maybe navigating a soft landing this time because of the combination of cutting rates sooner than expected and still having a lot of excess liquidity floating around the markets?
Well, it's a great question. And we talked about this, a few weeks ago, 3-4 weeks ago, that if the Fed really wants to do a soft landing, they're going to have to manage interest rates lower as well to make sure the economic landing is positive and not a hard or crash landing, right? So might they be trying to get ahead of themselves a little now and cutting rates and really trying to micromanage the economy? Now, that, to some that may seem like a great idea, right? The Fed knows everything. The Fed will just micromanage our way. They'll raise rates, they'll lower rates, and they'll just get us to this Goldilocks economic scenario. But the Fed has never called a recession. The Fed didn't see 2008 coming in March of 2008. Right. In 2020, when supply lines were completely shut down and the fiscal and monetary stimulus was, something we've never seen before, they didn't think there was going to be inflation. So, it's almost like you put me in a pilot seat of an airplane and tell me to gently land a plane. I don't know what I'm doing. They don't know what they're doing. No one really knows what's going to happen with the economy here. So you have to be really careful, if you're the Fed, of having the arrogance to think that you do know what's going on and that you can gently apply rates, lower rates, raise rates, and that's the steering wheel of the economy. There's so much more to it. So, again, I don't know what they're thinking with this dovish tilt. They clearly see the economy slowing, right? If you look at their economic projections, they only see economic growth of about 1.4% next year. Their long run growth rate is 1.8. So they see subnormal growth. They see inflation coming down, but they don't see the unemployment rate really. They see it going up to 4.1 until last week. It was at 3.9. So they're really painting this Goldilocks picture of this perfect economy. And, some of that may be because they think they'll lower rates a little and it'll just create this normalization. But, if you look at graphs of interest rates, of Fed funds, of the economy, they don't really just flatline. They're growing or they're shrinking most of the time. So are we going to be shrinking? And versus kind of more of this flatline normalization that the Fed's starting to think about. And, those are all things that we're just going to have to wait and see.
Right. And again, this is what makes it, so challenging in terms of managing money. But again, there's so many, YouTube podcasters or media channels of varying opinions. I mean, you've got some that are extremely bearish. The end of the world's coming. Felix Zulauf just recently did a video with Adam Taggart talking about how interest rates are going to go back to 5% next year. It's going to be kind of hard to see that happening unless you have a big resurgence of inflation, which is exactly what the Fed's suggesting they don't want, but are potentially now setting up. So maybe he'll be right. I don't know. But that's, right. Then you have Jeff Gundlach saying yields will be at 3% next year. Right. Who's going to be right? And these are guys that are well respected, right?
And if the Fed gets too far ahead of themselves and starts cutting rates, they say they're going to cut rates now 3 times next year, according to their projections. Maybe the bond market doesn't like that, right? And yields start going higher.
I don't know. The market seems to be liking it right now because yields will be below 4% this morning.
Right. Today they do, but they've introduced a risk. They've raised, one of my concerns about bonds is that the Fed starts cutting rates way too fast. And the bond market freaks out because this is what happened 3 years ago, and it generates inflation or it keeps it sticky, and yields pop back up again. And I think they've increased the risk. I don't think it's substantial at this point, but that risk is certainly higher today than it was yesterday. Again, it's not a high risk. I still think yields are going down, but the Fed, by trying to steer this airplane, this behemoth of an airplane, whatever they do, they're going to introduce they're going to change the risk profile.
Right.
And that's what they're doing. Lance, you were talking about there's a lot of bulls and bears on the economy.
Right.
And, just to be fair, I think we get labeled very bearish. But I think what we've been kind of preaching is that the economy is slowing down, but a lot of it's just normalization. We're getting back to kind of the pre-pandemic levels. And that's important to understand. We can't run at the rate we were running in 2022, 2021. Those rates are completely unsustainable. And at some point, we will get back to long-term economic growth rates, which are about 2%. And it's inevitable. And so,
and interestingly enough, that's a very interesting point, because getting back to 2% may feel recessionary to a lot of people after having such strong rates of economic growth in 2020, 2021.
Right. But, we're going to normalize. And that's kind of the easy one, because even if this plane is going to crash, you first go through the normalization part, where you go from fast to normal to slow to crash. So
to stop.
But no one knows that we are going to crash, and no one knows that we are going to normalize. Right. All we can do is look at data as it comes out. We can tell us what the markets are pricing in. We can read transcripts from earnings reports to tell us what companies like Walmart and Target and big retailers are telling us, what the banks are telling us, and try to look ahead and understand how what the Fed is doing right now may change things or may not. Yeah. Will lower yields generate more activity in the auto industry? Will it help housing a little bit? So, an economy is very dynamic. It's like the weather. It sounds nice when we get that 7-day weather forecast, but most times they're wrong. Most times the Fed is wrong. Most times the street is wrong. Very few people predict recessions. So, again, we'll just keep our head on a swivel here and take in these new data points from the Fed and their changing tone. And, we'll see where it takes us.
No, that's right. And look, and expect yields to pop up here a bit. Yields are very, very overbought, just like the stock market is. So again, there'll be something that happens. We're going to have a pop in oil prices, or because oil prices are very oversold. Go ahead.
Even forgetting the technical situation in bonds that they're very overbought, the Fed has just introduced, by becoming more dovish than expected, a reason for yields to go higher. Correct. So it's not just technically, which certainly I agree with you. They're overdue for yields to come back up a little bit, but the Fed is now adding a bias for higher yields as well.
Correct.
So they've changed the tone of the bond market, which seemed yesterday and today seems great, but again, we'll see what happens here as we move on.
And again, markets are going to ebb and flow. Nothing goes straight up, nothing goes straight down, and it's been a great run and down, and a run for bond prices here. You're going to get a correction. Now, where that correction goes, do yields go back up to 5%? I don't think so. That's probably a lot, unless there's really a big pickup in inflation all of a sudden for one reason or the other. But yields are, to your point, and I agree with you, is that yields are going to reverse a little bit here, which will give you an opportunity to buy some duration if you haven't done so yet. But
right,
there you go, Mike. Go ahead.
And again, real quick, if yields go back up to 5%, we start reintroducing the hard landing scenarios.
Exactly right. So the point is drive the car, pay attention to the road ahead of you, and make adjustments as needed. There you go.
Yep.
And don't crash.
And don't drink and drive.
There you go. All right, Mike, thanks so much. All right, that wraps up the show for today. Be sure and get by the website. Get signed up for the conference coming up January the 27th. It is not going to be recorded. We have some copyright issues with our keynote speaker, so there will not be a video version of this. So if you want to come to the conference, you got to come. So buy your tickets. They're on the website now, realinvestmentadvice.com. Have a great day. Tomorrow, Financial Fitness Friday with Danny and Richard. See you then.